President and Chief Investment Strategist at Yardeni Research. Thank you so much for taking time out and, just assessing by what the Federal Reserve did overnight, shifting its dot plot to project now only one rate cut this year from the earlier four in FY25. How do you believe that one should read into this?
Well, started out the year with many investors in the markets indicating that we might get 6 or 7 cuts in the federal funds rate. I never really understood that. I think it was just sort of the after effects of so many people being wrong about a recession over the past 2 years that they felt that the economy wouldn't be able to withstand this kind of level of interest rates and that the Federal Reserve would have to lower interest rates to avoid a recession. But I think interest rates have actually normalized. They're normal. They're back to where they should be. The 10-year bond yield in the United States should be between 4 and 5%. That's where it was before the great financial crisis. And so I think we're just seeing normalization in the financial markets, and the stock market has demonstrated that it can certainly tolerate these levels of interest rates as long as the economy can do so. And so far, so good. And I think Fed officials are coming around to that view that there's really no rush to lower interest rates. They don't want to make the mistake that the ECB just made, where the European Central Bank lowered their deposit rate by a quarter point and at the same time announced that that might be one and done for a while.
Yet, I was just thinking through it. While Fed is crucial, Fed is important. We look up to Fed in terms of getting a guidance to what is happening to the world and what is happening to the US economy in specific. But is Fed really losing its relevance from a financial market standpoint? Because frankly, financial markets have moved independently of what the Fed communication has been, at least in the last 18 months.
Right. Well, to tell you the truth, I hope so. I hope it's becoming less relevant because it's been all too relevant for too long. It seems that the markets have basically been a puppet that's been controlled by the Fed pulling on the strings. And the reality is that a lot of the inflation that we had was related to the pandemic, and inflation in recent months over the past, really since the summer of 2020, has been moderating all by itself. We didn't have to have a recession in the US to bring inflation down. China's been in a property recession, and they're exporting deflation to the rest of the world, including the United States. And meanwhile, rent inflation is coming down in the United States. So between goods inflation and services inflation coming down, I'm not quite sure why the Fed feels a need to be front and center here. They could put low key here and recognize that in terms of their dual mandate, the economy is doing fine and inflation's moderating. So maybe interest rates are where they should be.
Okay. Where do you see emerging markets moving now? The historical template is interest rates, when they peak out, money moves back into emerging markets.
Right.
Now, interest rates, sir, have peaked out. Does that mean emerging market party will start again?
Well, I think that the days when we could look at emerging markets as an asset class and just overweight ETF emerging markets, I think those days are over. I think we've got to be much more discriminating, and investors clearly have been much more discriminating. They haven't been buying China. They haven't been buying India. They haven't been buying Mexico. They haven't been buying the commodity producers like Brazil. I think much will depend for the commodity producers of the emerging markets on commodity prices, and commodity prices look like they're going to stay fairly quiet here for a while because the global economy isn't booming. It's not taking a dive. It's just kind of muddling along. And if commodity prices just continue to move sideways here, I think that's keeps some of these commodity-related emerging markets from doing much of anything. Meanwhile, I think it's, as you mentioned in your conversation before, it's very much an issue for global investors of the extent to which they want to continue to plow into India, where valuation has become somewhat higher than obviously China, which, as you said, looks cheap. But India is, it's a democracy, as we just saw in the elections. Democracies sometimes lead to unexpected results, and Modi is still widely respected, but his party didn't do as well as was expected. But that's a sign of a healthy democracy. And meanwhile, it seems as though Modi is still very much in power and influence and is committed to increasing the vigor of the Indian economy. So as long as India continues to spend money on infrastructure and provides a relatively politically stable environment and predictable environment where the rule of law still matters, unlike China, where the government can change the rules on you overnight, I think India will continue to outperform China.
All right, Jed, really appreciate your time. So glad you could join us with your valuable
My pleasure.
inputs. All right, what
Thank
do we
you.
have? Looks like we're in for a good start. 100 points of a Nifty. New high yesterday, another new high.
If you like this video, then like, share and subscribe to ET Now.